Welcome to CoreLogic's update on housing market conditions for September 2016, brought to you on behalf of Credit Union SA. This month we're focusing on how the housing market performed in August, which of course coincided with the second time interest rates were cut during 2016. The August rate cut was the 12th since November 2011. Since that time, the Australian cash rate has reduced by 325 basis points to reach 1.5%, the lowest interest rate reading on record. Importantly for the housing market, mortgage rates haven't reduced by the same amount, with the average standard variable mortgage rate down 255 basis points over the same time, taking the typical standard variable mortgage rate to 5.25% and the discounted rate to 4.45%. Mortgage rates haven't been this low since 1960, which is likely to be one of the factors driving values higher. It's not just the low interest rates that are pushing dwelling values higher though in Australia. If it were, we'd be seeing much more uniform growth rates across the capital cities and regional areas of the country. In fact, the performance of the housing market's been diverse across Australia. Most capital city housing markets are only showing subtle growth trends, while Sydney and Melbourne have stood out based on their substantially higher rates of capital gains over the past two cycles. The current growth cycle kicked off in the middle of 2012 across most cities. Since that time, Sydney dwelling values have increased by 64% and Melbourne values are up by 44%. The next highest growth rate across the same period has been in Brisbane, where dwelling values are 18% higher. The lowest growth rates over the cycle can be found in Perth and Darwin, where dwelling values have increased by 8.2% and 9.7%. However, despite the growth rates over the past cycle, housing values have been falling in these cities since 2014. Other factors apart from low mortgage rates can explain the strong growth conditions that are evident in Sydney and Melbourne. Both cities have benefited from strong jobs growth, low unemployment, and high migration rates from both overseas and interstate. Additionally, low advertised stock levels are likely adding to some of the buyer urgency we're seeing in these cities. Listing numbers in Sydney and Melbourne have started to trend higher, as they do each spring, but overall listing numbers remain well below the long-term average levels. While growth conditions remain strong in Sydney and Melbourne, the annual trend of growth has been tapering since the middle of last year. Sydney's housing markets moved through a peak of annual growth in July last year at 18.4%. The annual pace of growth has since moderated back to 9.4% over the past 12 months. Similarly, growth in Melbourne has fallen from a peak of 14.2% to reach 9.1% over the past 12 months. Not all cities are seeing a decelerating growth trend though. The housing market in Canberra and Hobart have both gathered some pace over the past 12 months. A year ago, the annual trend of growth in Canberra was almost down 1% over the year. Over the past 12 months, the annual rate of growth has picked up to 7.6%. Similarly, in Hobart, the annual rate of capital gains has shifted from just 1.5% a year ago to reach 6.5% over the past 12 months. A more subtle growth trend is evident in Brisbane and Adelaide, where dwelling values are up by 4.4% and 3.1% over the past 12 months, while values continue to fall in Perth and Darwin, where economic and demographic conditions have weakened. Adelaide has continued to show a steady and sustainable trend pace of capital gains, despite a weak result in August, with dwelling values falling by 1% over the month. The annual trend has seen dwelling values rise by 3.1%, with most of the growth concentrated in the detached housing sector. Unit values have remained relatively flat over the year, recording a growth rate slightly below 1%. The average selling time across Adelaide has held reasonably firm over the past year at 55 days, compared with 56 days a year ago. However, discounting rates have started to slip, suggesting that vendors are becoming more flexible in their pricing expectations. Overall, the common thread across the Australian housing market is diversity. While the headline growth figures remain robust, it's very clear that capital gain conditions vary remarkably from region to region and across the housing types. Transaction numbers are trending lower, which at face value may suggest some weakening of demand. Nationally, there are 15% fewer sales across the housing market over the past 12 months. Digging a bit deeper though, and it's likely that lower transaction numbers aren't entirely attributable to less demand from buyers. While a reduction in housing demand is a likely explanation in the weak markets, like Perth and Darwin, the same can't be said for Sydney and Melbourne, where values are still racing higher at a very strong pace. These areas continue to show a low number of homes being advertised for sale, which is likely to be creating some level of urgency amongst buyers, which is supporting the upwards pressure on prices. Total listing numbers in Sydney remain below 20,000, and the number of newly advertised properties added to the marketplace last month was about 21% lower than a year ago. As the spring selling season starts to ramp up, we'd expect that listing numbers will also start their typical seasonal upswing. Whether this increased supply is absorbed by the marketplace will be important to monitor as the season progresses. If listing numbers do rise without a commensurate lift in buyer demand, we may see some further moderation in the rate of value growth that has been evident in Sydney and Melbourne over the past 4 years. Affordability barriers are likely to progressively add some natural resistance to housing demand if values do continue to rise. With wages growing at the lowest rate on record, it's hard to imagine this pace of dwelling value growth could continue much longer, at least in Sydney, where the dwelling price to income ratio is tracking at a record high of 8.4 times. Another likely break on the marketplace will be higher supply levels from newly constructed housing. Dwelling approvals data for July show that another surge in apartment approvals at a time when the number of high-rise apartments under construction is well and truly already at historic highs. While concerns around apartment supply are confined to specific areas, particularly across the 3 largest capitals, it's clear that high unit supply is weighing down the pace of capital gains in this sector of the market. In summary, Australia's housing market continues to show a strong level of resiliency in this record low interest rate environment, despite the many moving parts and somewhat divergent underlying trends. However, there are some headwinds that may prevent growth rates from re-accelerating, even if interest rates do move even lower later this year. As always, thanks for tuning into CoreLogic's Housing Market Update. We're always updating our housing market research at www.corelogic.com.au.